So thank you everyone for attending today's panel discussion. This is the Cryptocurrencies and Future of Fintech panel at the once again virtual Princeton Reunions. We didn't expect to be here again this year, but here we are, and we're excited that we're here to do a panel discussion on a really interesting topic. This panel was put together by the alumni members of the Julius Rabinowitz Center for Public Policy and Finance. The JRC is an interdisciplinary center at Princeton that focuses on financial policy and really all aspects of the intersection of economics and policy in the U.S. and also internationally. So this is a pretty pertinent topic, and it fits our center's focus very well. Marina is my other co-moderator today. Marina Finley, class of 2019, is going to say a few words about the panelists that we have today with us.
We are very excited to moderate this discussion with 4 Princeton alumni who are deeply involved with all aspects of the blockchain and cryptocurrency revolution. We have Ben Davenport, 98, who's the founder and former CTO of BitGo, the leading wallet, security, and infrastructure company for Bitcoin and other cryptocurrencies. Previously, he co-founded Beluga, which was acquired by Facebook and became the basis for Facebook Messenger. Previously at Google, he helped build the first version of AdSense. He started his career as an engineer at Microsoft. He's an active angel investor, having invested in 80+ companies. Shiv Dutt, 11, graduated Princeton with a degree in math. He spent the next decade working at the intersection of finance and technology at various hedge funds, investment banks, including Goldman Sachs, commercial banks, consulting companies, and startups. Since 2017, Shiv has been immersed in the blockchain and cryptocurrency space, building out the cryptocurrency exchange, blockchain payments platform, essentially a Venmo for banks, and cryptocurrency market data index and platform for his company Tassat. In April 2021, Shiv left to launch his own venture.
Yep, and then our next panelist is Kimberly Quinones, a member of the Gray Class of 1982. She's a director with the Global Blockchain Business Council and was the founding executive director of the New York City Blockchain Center, a public-private partnership with the New York City Economic Development Corporation. Her career has spanned finance, government, nonprofit sectors. She spent 3 decades as a public finance banker in New York and Los Angeles, specializing in infrastructure and general fund financings for large and frequent issuers of municipal bonds. She also served as the CFO of a New York State public authority and in the office of the Mayor of New York City. In the nonprofit sector, she has been an advocate for women through her involvement in the Financial Women's Association of New York and California Women Lead. She was a member of the Board of Governors of the Municipal Forum of New York, the Vanderbilt YMCA, the California Volunteers Commission, and the Committee on Fiscal and Economic Priorities. And then our final panelist today is Jeff Tang, class of 2009. He started his high-frequency trading career at GetCo in Chicago and Singapore, where he traded on electronic exchanges in all 3 major time zones, 4 asset classes, which are equities, fixed income, commodities, and foreign exchange, and 3 instrument types, cash, futures, and options. After a stint trading Asian markets at his proprietary trading firm Serenity, he transitioned to cryptocurrency trading, where he has consulted for some of the larger trading firms in the space. Most recently, he started a crypto trading and investment firm called Gravity. He lives in Rio Grande, Puerto Rico, and graduated with a BSc degree in operations research and financial engineering. So those are our illustrious panelists. I know you're excited, as I am, to hear what they have to say about crypto. And we've asked them to start off with a very thought-provoking question about what they're all keeping an eye on in the cryptocurrency and blockchain space. They're going to give us their thoughts on what they think is kind of the most intriguing developments going on in that sector, and then we'll dive into some more detailed questions. So Jeff, since he's first on my screen, do you want to take it away?
Yeah, sure. For me as a trader, I think one of the areas of the greatest expansion over the past 2 years has been institutional crypto. And there are a few general areas, just thinking back in 2017 when I started looking into crypto, is, for example, very difficult to send sell orders if you didn't own Bitcoin. And there have been a lot of new companies such as BlockFi, Genesis, Compound Finance, which enable borrow and lending. On the custody side, there have been a very large number of new institutions in the space, such as Anchorage. And then on the execution services side, for the larger institutional players, NYDIG, Tagomi, which is now Coinbase Institutional, FalconX. 5 or 6 years ago, a lot of these institutions would have been unheard of. And so I feel like that has been an area of great expansion for me. And I'm really excited about what the next few years will bring.
Great. Kimberly, you want to go next?
Sure. We're a global business association for the blockchain industry. And what is, if you had asked me a week ago this question, I would have said regulation. Ask me today, and I adamantly will say regulation. There have been, there's been a lot of signaling from the US regulators, and it's a veritable alphabet soup of regulators. But once Gensler came in at the SEC, and he had previously been at the CFTC and had handled regulating swaps after the financial crisis and the Great Recession. He's not afraid of tackling difficult subjects, and this is one of them. And having greater coordination among all the different regulators here in the US, regulatory certainty will help the business and help investors. And that's just US. Then we've got UK, we've got EU, Asia, Africa, so regulation. The other thing on my mind is that I'm the only person on this panel with a blazer on, so I feel compelled to tell you that my preferred pronouns are okay, boomer.
Great, and we have some questions later on about regulation, so that's perfect timing there. Ben, do you want to go next?
Yeah, sure. Like Jeff said, you know, institutionalization has been really the dominant story of the last, you know, of this cycle, probably starting really, I think, going back to 2017 when you first saw CME launch futures, which is really the, you know, that was kind of at the peak of the last bull market. But, you know, since then in this cycle, we've seen sort of at an accelerating pace. You know, we've seen mainstream Wall Street players like Goldman and Morgan Stanley bringing offerings onto their platforms, really, I think, being demanded by their clients. You know, one thing I didn't have on my you know, prediction scorecard for this cycle was sort of the corporate America balance sheets, Bitcoin and other assets starting to pop up there. But we're starting to see that. You know, Michael Saylor at MicroStrategy lead the way. We saw Elon at Tesla allocate about $1.5 billion. You know, he's still sort of wrestling with some questions there, but we'll see where he nets out. And then alongside, again, you know, I think the lending market is another thing I'm really looking at. I mean, the lending market has just surged in size. Just one firm, Genesis, originated about 20 billion of crypto-based loans just last quarter. Which I think was more than they did in all of 2020. You know, and I think we're seeing the beginnings of Bitcoin as, and Bitcoin in particular, as kind of the best collateral to lend against. I just went through a mortgage on my home, and the process was painful. You know, I predict in 5 years you'll be able to borrow against Bitcoin at reasonable rates as opposed to the double-digit rates you're seeing today. And then, of course, regulatory. The market's just too big to ignore now. We've got a $2 trillion total market cap. It's not going away. The regulators, you know, they might have thought, okay, this is going to die back in 2017. That's no longer the case. They have to pay attention. I think we're going to continue to see that regulatory drumbeat, and you know, there's going to be some convergent regulation between the U.S. and Europe and others. But then I think we're also going to see some competitive regulation and see, you know, the innovators and the capital is going to go where it treats them friendliest.
Yep, that makes sense. And then finally, Shiv.
Cool. So, the one thing I will say is that there is a lot of attention, a lot of hype, and a lot of activity and flurry happening in the crypto and blockchain space. So, you know, I remember talking to somebody about the origin of bicycles, you know, just cycles, and you know, they went through every single configuration. every single configuration you can imagine. Like people tried everything out till we finally settled on, the form that exists today. So that tends to be the nature with things that are, starting out. Like people just try everything and there's a shakeout, and then finally, things end up in a particular configuration. So, for people looking for careers, I think, whether you're a lawyer, an engineer, marketing, whatever you're doing, there's a lot of attention, and people often feel that, only the tech savvy or engineering type of people can work in crypto, but that's not the case at all. I've seen all kinds of people into the space. I think, there's just a range of companies that are trying to do work in the space. There's a ton of startups, people who are doing analytics, people who are trying to build trading platforms, exchanges, payments platforms, the banks are getting involved, even companies like, social media companies, tech companies like Facebook. So it's just, everybody's involved in the space in some way or the other. Before I launched my current ventures, I was actually talking to a guy, for a founding role in, his fishing company. And he had a very interesting point that, in fishing, there's up to 50 steps between 50 transactions that happen between the fish getting caught and it ending up on your plate. And, so he wanted to put that process on a blockchain, to eliminate waste. So the applications are just boundless. You see them just applying everywhere. I had another friend who wanted to apply it to the jewelry space. Somebody else was doing blockchain in real estate. So I think there's a lot of flurry, there's a lot of activity. And, a lot of things will fail, but there's certainly a lot of attention being paid to the space. There's also a ton of volatility, and I have friends who just love to trade, and they used to trade stocks, and they were doing okay, and suddenly they're able to just get so much more activity in the crypto space. So if you're looking for stuff that's moving, stuff that's exciting, that's another exciting thing.
Thanks, guys. The second question we were planning to ask was, do you see the kind of rise in retail and institutional investing in the crypto space as a temporary fad, or more of a long-term growth pattern that will stay? But it sounds just from your response to the first question that everyone seems to have that opinion, and I don't see any dissenters. So we might just move on to the next question that actually is somewhat relevant to something Ben brought up. I'm not sure if you were saying, Ben, that you refinance your mortgage using Bitcoin as collateral.
No, I didn't. It was a traditional refi, and okay. I just saw the length of time and the effort to go through to do that, and comparing Bitcoin as collateral, the loans that are being made today, that collateral can be liquidated 24/7, at the push of a button. Whereas, without all the cost of, and uncertainty of real estate. And so I think that's what I was kind of saying, getting at, is it's going to make a better collateral for loans than real estate in many cases.
Well, one of the fundamental questions, criticisms of cryptocurrency, is that it isn't backed by anything, right? Do you guys see this as a hurdle that can be overcome? How does the industry de-risk itself to be more appealing to institutional investors and regulators, especially with regulators' enhanced scrutiny on exchanges and ICOs? Just opening this up to the panel.
Well, I think enhanced regulatory scrutiny will actually make people feel more comfortable in being involved in the market to a certain extent. And I will point out that what's different about this market and most other financial markets is that it started mostly retail, and now it's evolving to involve institutional investors, whereas a lot of them go the other way around. So it's a process that we're not used to.
On the not backed by anything kind of question, the first thing I always ask somebody who asks that is, what backs gold? And then what backs the dollar? The dollar used to be backed by gold. What backs gold? Ultimately, the answer is the same to both of these, which is it's nothing. It's solely sort of collective belief. Gold is just a yellow metal that happened to have the right set of properties to make it a monetary asset that the world converged on about 5,000 years ago. And so these things are fundamentally different than cash flow assets like bonds and stocks. You can take the cash flows of a bond or a stock and calculate an intrinsic value. These things, the dollar, the gold, Bitcoin, are monetary assets. They don't produce cash flows. And so what they really are is they're, what I consider them is to be equilibrium solutions, which in game theory are called Schelling points or focal points in a coordination game. And what this game is you, as an individual or a company, you want to hold the money that everybody else will want to hold, and that helps you preserve your purchasing power over time. And because these focal points are so powerful, it's exceedingly rare that one gets disrupted. But we may be witnessing in our lifetimes, the disruption of, say, gold for Bitcoin. So that's one thing I think we're looking at.
Yeah, absolutely. I was going to say, I'd like to, I definitely agree with Ben. Just everything is based on faith, right? Like why is why U.S. bonds so secure? So people have this collective faith that the U.S. government is secure enough and will definitely pay them back, right? So, I think crypto is getting more attention with time. One thing I would like to say, though, is that from my experience, what I've seen is that, so the underlying protocol, blockchain, right, is, in my opinion, definitely here to stay. It'll find its place in the world. It's brilliant. It's beautiful. It has so many applications to do so many different fields. So cryptocurrency is the application of blockchain to currency, right? And we have tons of coins. I think I remember reading that there's about 1,300 coins out there right now. There's a famous investor, Peter Mallouk. He runs a $50 billion plus fund called Creative Planning. And I remember reading an interview of his where he was saying that 99.99% of these coins are going to zero, not some okay state. They're going to zero. So so cryptocurrency is one application of blockchain, and within cryptocurrency there are a lot of coins out there, and it's very hard to predict which ones are going to be successful. Like, Bitcoin has is very prominent right now, but it's very hard to predict what's going to happen over the course of several years. And probably what we'll end up seeing is some, updated version of Bitcoin, or something similar will eventually dominate. But it's very hard to predict right now. So even though, so coming back, to the previous question where, the underlying protocol blockchain is here to stay, cryptos are here to stay, but it's very unclear what form they're going to be in, and it's very hard to justify one coin being the dominant force going forward.
Yeah, and I think that in terms of cryptocurrencies not being backed by anything, there is a subset of cryptocurrencies at the moment which are backed by things. And unfortunately, the largest one is somewhat controversial, which is Tether. So, putting Tether aside, which is a stable coin, which is backed one-to-one supposedly by fiat reserves. There's also USDC, which is regulated from a circle. There's True USD, there's Pax, BUSD, which is Binance USD, and HUSD, which is Huobi USD, among others. So these stable coins, before 2017, stable coins were an amazing idea, but they weren't really they weren't very standard. But at the moment, if you look at, for example, today, such as Binance, Huobi, OKEx, these are some of the largest exchanges by volume in the world. If you look at ftx.com/volume-monitor, you can see some of them. And stablecoins are now responsible for more than 50% of all fiat, 50% of all spot transactions. And so they're now definitely mainstream, and they are backed by something. And then on the non-stablecoin side, there are products like Pax Gold, the ticker is PAXG, and Tether Gold. And so these are cryptocurrencies which are backed by gold. I think that over time, and then the short answer to how to make this de-risk is for more regulated products like ETFs. ETFs are a way for retail and institutions to have the ability to be protected from an investor perspective. And at the moment in Canada, for example, there are very recently from February of this year, there are a few Bitcoin ETFs and there are a few Ethereum ETFs as well. And they're freely traded, and they have daily creation and redemption mechanisms. Inside the United States, unfortunately, these products don't exist yet. All of the crypto-related underlying stocks are in the form of trusts, such as Grayscale. That's the largest one. Their biggest ticker is GBBC, which is the Bitcoin Trust. There's also Ethereum, ETHE, among a large number of symbols as well. With more ETFs in the ecosystem, that is a safer way to invest into cryptocurrencies than in the current non-stock marketplace.
I think because we were talking about stable coins, it's useful to point out that basically they're used legging in and out of trades into other cryptocurrencies mostly. So when the use of the stable coins goes up, it's because trading activity is going up. They're not yet frequently being used for payments. And I'd be curious what the rest of the panel thinks about the dynamic between speculative value and utility value of different cryptocurrencies. Are we moving from a phase where utility value will be more prevalent?
Well, I think you're going to see, you know, things like Facebook come online with their currency, which is going to ultimately end up being a dollar-backed coin. That's going to be more of a retail product. Obviously, they have the distribution to make a retail go of that better than anybody else out there. So I think that's going to be going head to. But I don't see something like that competing with the decentralized coins out there like Bitcoin and Ethereum. It's solving a different use case and solving a payments use case. I think it's competing much more on the par with the Chinese CBDC that is either launched or launching, and some of the Western CBDCs that are probably still 10 years away from seeing the light of day. I think in the West, the corporates will effectively bring CBDCs to market.
Well, actually, what the Fed just yesterday announced that they're going to be releasing a paper. The Federal Reserve Bank in Boston is actively doing testing and studies with MIT, with the blockchain group there, and they're releasing a paper this summer, actually.
That's kind of my point, is that they're releasing a paper, and so we're about 10 years from actual deployment.
But actually, they're speeding up. It was supposed to be later this year, and they moved it up to this summer. And I think China is on track. Everyone's expecting it in conjunction with the 2022 Beijing Olympics. And little known fact, Bahamas and Cambodia already have CBDCs out there in use.
Here's one of my questions about CBDCs, particularly around the dollar, is I don't think CBDCs disrupt Bitcoin, because it's still ultimately dollars at the end of the day. If you're opting into Bitcoin, it's because you believe the dollar is not a stable store of value over the long term, which it has not been. But I think the issue with CBDCs is they kind of disrupt the banking system, because if you look at a CBDC, if you have a retail accessible CBDC where you can hold dollars with the Fed, in times of crisis when banks are under pressure, why would you hold your dollars at a bank? You would hold it directly with the Fed. So that it's like a catch-22, for the banking system, which ultimately is tied up and owns the Fed. So they've
got the dynamic now between, they want to prove that they're not being left behind by China, but by the same token, it's systemically important. It'll be another component that will really affect the banking system, and they have to get it right. So that's
I just want to jump in. Yeah, I just want to jump in here because that was actually our next question. We were actually just about to ask about CBDCs. And so I guess one follow-up would be, one of the things about Bitcoin that's very attractive to people, right, is the sense of anonymity, the fact that it's decentralized, right, the fact that it's outside of government control today in most parts of the world. Do you envision CBDCs kind of threatening that ecosystem of Bitcoin? Is it something that will exist in conjunction with kind of more decentralized platforms, or do these CBDCs suck up all the oxygen in the room and kind of leave all the original cryptocurrencies out to dry, and people just kind of say, I'd rather invest in a cryptocurrency backed by the Fed, which has that store of value that we talked about, with traditional currencies, instead of putting my money with, some other cryptocurrency that's just backed by value, by faith alone.
Well, I would say that the $1 trillion of wealth that's currently stored in Bitcoin has not gone to Bitcoin because it wanted to move, money around more easily than their banks were allowing it, or than the Fed was allowing it. And that's not the reason at all. So the reason that it's gone there is because they don't see any end in sight to the money printing by the Fed and then spending by the Congress. And so I think they, there's no real crowding out, of Bitcoin or things like it by CBDCs, in my opinion.
Yeah, I think.
Go ahead.
Sorry. I think when CBDCs are in full bloom, I think I would much rather trade Bitcoin denominated by that currency rather than Bitcoin denominated by Tether. Tether has a long history of, some things that have been doing very well with it and some things that have not been doing well with it, such as, crypto capital, et cetera. And Bitfinex has been hacked before in 2016. And Bitfinex and Tether are related companies and entities. So I think from a security perspective and from a safety perspective, it will be good, but at the same time, as Ben mentioned, stablecoins are stablecoins, also as Kimberly mentioned, for transactions and for as a way to transact cryptocurrencies among them or between them. They're not really used for investment purposes. And however, from just a trading perspective, it will be much better for USDC, for example, which is regulated in Circle and Coinbase. They're able to destroy USDC when regulators and the governments say, hey, this has been illegal activities. Well, we have to do something about it. And I see that it'll be the same for CBDCs.
And CBDCs could be wholesale or retail. They could be within the banking system, or they could be for individuals to transact with. So that's another question and distinction and a consideration every time a government is looking at developing one. And the other point that I bring up is that, Bitcoin is inconvenient to pay for things. You have to pay taxes every time or not taxes, but you incur a tax liability every time you transact. That's not going to happen. So Bitcoin is going to stay an investment, and stable coins and maybe potentially CBDCs, whether they're corporate or whether they're central banks. The stable coins are the corporate ones, but a bank-backed CBDC, central bank, that's what's going to be used for the payment system. So it's different things. And I do think there's tremendous potential for blockchain to facilitate faster, cheaper payments and looking at banking the unbanked. So
that ties into another question we wanted to ask. What are the biggest ways that you see digital currencies and blockchain technology impacting emerging forms of commerce, like the fintech payment space, the Internet of Things, et cetera? And 5-10 years down the road, how do you see this technology affecting the general public and our day-to-day lives?
Let's jump in first.
Well, so I think kind of with the phishing example I gave, right? Anytime you have a series of transactions, right? I think we'll see blockchain applications there that applies to anything the moment there's a supply chain anywhere. So I think we'll see blockchain getting really widespread. We'll also probably see there's been a trend of things as a service, for example, software as a service, SaaS, right? It's been very popular, and people have kind of companies like AWS, Amazon have taken that and done infrastructure as a service, platform as a service. In fact, now we're seeing companies like Firebase, owned by Google, doing backend as a service, where you can build a front end for an application and they handle everything on the back end for you. So I think we'll start also seeing blockchain as a service where some of these bigger players will provide blockchain applications, and if you're a small company, with a series of transactions, you'll be able to use that service. So I think that we'll see widespread application of that.
I mean, on the payments front, I think like you're not going to see orders of magnitude improvement over where we are today. I mean, if you've used Apple Pay, which I'm sure almost everybody has, or WePay or Alipay in China, these things are fast, they're reliable, they work, and I just don't see I don't see necessarily cryptocurrencies adding an additional amount of value there. You have to separate kind of like the technology that you're using for the payment from the sort of the unit of the currency unit that you're storing your balance in. This is technology. It can easily translate between whatever currency you choose to hold. If you hold dollars, it can translate to RMB. If you hold Bitcoin, it can translate to dollars at the point of payment. So that stuff is really trivial. So I think the bigger war is, for mindshare in terms of what do you hold? Not so much in the $1,000 that you hold on your phone, but in, where do you put your savings? Where do you put your life savings that you want to be safe from inflation and be there when you need it in 30 years?
And there's also the aspect of blockchain technology, not just the cryptocurrencies, but the underlying technology being used in places like securities settlement. There are all different ways it can make transactions settle and be processed faster and more cheaply, frankly. And that's not going to be something that you're going to see and you're going to necessarily know. A corporation is going to be applying that in the background, but you as a consumer won't necessarily know that.
I think in terms of individual technologies, I slightly disagree with Ben. I think that there are some use cases that are currently being built on blockchain. So for example, there's this one cryptocurrency called Cello, and they are trying to be a mobile first blockchain where the public keys are your cell phone number or your email address, and then you can transact, they have their own stable coins. You can transact offline. And so, in third world countries, I can send you $1, or I can send you a euro or a local currency. We can do it offline and from my phone to your phone, and then later on it, resyncs with the blockchain. So I think there are quite a few of these projects out there. Whether or not they'll become mainstream, there are definitely hurdles to overcome, such as the local central banks probably aren't going to be very happy about these kinds of disruptive technologies. But in terms of banking the unbanked, in terms of faster facilitation of money in a lot of third world countries, that is a very that is an area of extreme need. And I think there are quite a few cryptocurrency projects that are addressing this.
Great.
That's a great point.
Kind of touching.
Everything works so well. Go ahead.
I don't know. Please continue. Oh, okay. I think one of the things that was brought up kind of a couple times now, I think kind of this issue, and some of the people in the audience have been asking us questions about this issue of security, right? I think this is something when people think about Bitcoin, they really think about, the first thing that comes to mind, right, is people losing money, the volatility of the coins, Mt. Gox, right, a number of years ago where all that money went missing, people forgetting the password to their virtual wallet, right, all that kind of stuff that you don't necessarily see with $1 or a pound, right? So I want but the broader question is, are there some straightforward kind of common sense steps that need to be taken either by the currencies themselves, the exchanges? Does the government play a role? What are some steps that can be taken to improve the perception of cryptocurrency in the eyes of the public as being a safe thing to invest in? And what kind of steps can be done to prevent the kinds of negative things that cryptocurrency is associated with, money laundering, right? People trying to evade sanctions. What kind of a role does the government or the exchanges or the currencies have to combat these kinds of abuses of the technology and kind of propping up the reliability or the faith people have that, you know, they're going to buy a cryptocurrency, they're not going to see it disappear overnight?
I'll jump into this, you know, partly because, you know, the company that I co-founded in 2014, BitGo, was largely, you know, created to try to solve this problem. Originally for the end user market, but then eventually really in the sort of the exchange or the business to business market. But yeah, I mean, you know, if you look back to 2011 through 2013, you know, it didn't matter whether you held Bitcoin yourself or you held Bitcoin, you know, at Mt. Gox or you know, 6 other exchanges where there were hacks and major losses. I mean, there were so many ways to lose your money in those days. And I do think we are in a better place today, largely due to, you know, there haven't been so many, there've been some developments, you know, like hardware wallets have made doing self-custody a much safer experience. But you know, most people, you know, shouldn't jump into doing that. Most people I tell, if they're going to buy their first cryptocurrency, I say, you know, you're going to buy it on Coinbase, just leave it there until you know, have put in the time. And it takes a significant amount of time and effort to, you know, make sure you've done the steps right. Make sure that you have, you know, if you get hit by a bus tomorrow, that your spouse is going to be able to get it or your kids are going to be able to get it. And so I think over time, I think most people are going to have their first interactions with Bitcoin or other cryptocurrencies through a custodian, or even, you know, through a multi-layers of custodian. It'll be through eventually, I think, an ETF later this year. And, you know, many people don't want the, you know, the challenge and the headaches of holding those keys themselves. They want the exposure to the price. And so I think, you know, we are in a much better place. And so to answer the second part of your question around sort of, you know, pushing back on the money laundering and crime and so forth, I think, you know, the blockchain analytics firms that are doing, you know, great work in sort of attaching names to these anonymous addresses on the blockchain. You know, I saw you know, there was a prosecution that used, you know, a Bitcoin transaction from 11 years ago to find the guy and indict and arrest him. So these things never go away. Bitcoin is actually a terrible, and the other currencies are pretty much terrible ways to do criminal activity, because it leaves a permanent trail and the amount of information attached to the blockchain only increases over time. So, you know, I think those things are helping move the narrative in the right direction.
Yeah, I think I'd like to second what Ben said. I think ETF investing is a great way to go if you believe in the space. You know, so again, like I said, it's hard to predict what coin is going to, you know, be the winner. But if you believe that blockchain is going to be an expanding space, you know, there are a lot of ETFs. You know, I invested in a bunch myself. I think Block BLOK was one of them. You know, the funds like Kathy Wood's ARK Invest, you know, a lot of respect for the way she analyzes things, and she has an innovation fund that, you know, invests in blockchain as well. So I think that's a really good way to go about it.
But there's a distinction between the actual cryptocurrency and then the businesses around cryptocurrency. And let's be clear, what's going on in the US is the businesses around cryptocurrency more than any fund, except for like a Grayscale that actually has the Bitcoin itself. We don't have that yet.
Yes, that's right. Though I think we're likely to within 2 years, I'll say.
So kind of just a follow-up on that, right? The SEC has been fairly loath to approve a lot of, you know, cryptocurrency related investments. The SEC, the CFTC, all of these alphabet soup agencies are generally very skeptical of cryptocurrency, right? They've been going after people doing ICOs. Even the crypto ETFs, right, are not a done deal. So So what is your view on kind of the government sensing this is kind of a threat to our authority? Did they start clamping down on these things? Or is this something where you think that public pressure will eventually force the SEC's hand and say, all right, we're going to have to allow ICOs, we're going to have to allow crypto ETFs, we're going to have to allow people paying their taxes with crypto or something like that?
Yeah, I mean, I think the viewpoint of a regulator is always, don't do something that's gonna, get splashed across the New York Times, right? Eventually, they approve a Bitcoin ETF and then, Bitcoin goes to zero and they look like, they have egg on their face, right? So they're always, it's always career risk. And so, I think we've seen that for the last 3 years. But when it comes down to it, in terms of actual investor protection, which is the SEC's mandate, there have been many investors who have, fundamentally been hurt by exchange hacks or these other things by not having a reliable investment product, or they've had to invest in things like GBTC, which, until recently have traded at, premium, so they've been effectively been paying 10 to 30% over market for Bitcoin. Now that's gone to a discount. But I think like it's high past time that they do this, and I think they will. But I think that Gensler is going to probably. It seems like he's making a sort of regulatory grab in the process of doing that. In exchange for an ETF, we get SEC regulation of all onshore spot exchanges, for instance.
I think all that remains to be seen, but what was different was that just this week you had the Treasury releasing a statement about cryptocurrencies, you had the SEC making statements, you had the OCC making statements. We know that Gensler does understand crypto. He taught a class at MIT, which by the way is available on YouTube. Anybody can watch the whole class. So they do recognize that it's there, it's happening. The administration, I think, wants to be pro-business, but make sure that people pay their taxes and that ultimately the investor gets protected. So how you coordinate the different agencies to come up with a regulatory scheme would be the right question.
Yeah, and on the demand side, it's very clear that from a retail perspective, the demand for cryptocurrencies in an equity mechanism is way past due. I mean, if you think about what's available right now, GBBC, the management fee is 2%. That's above market if it were to be an ETF. Some of the competitors out there, such as Osprey, are significantly lower at 0.49%. But in any case, these are very high management fee processes, not just because of the premium. So every year you're dripping away 2% for Bitcoin and 2.5% for Ethereum. Similarly, if you look outside of just holding cryptocurrencies, stocks that are tangentially related to crypto, such as Riot Blockchain or Marathon, or you have Galaxy in Canada, or MicroStrategy even has kind of become a proxy for holding something that's similar to crypto. And you look at the price of MicroStrategy, it has been astronomical over the past 6 months, 7 months. It's kind of like a mini GameStop. It's gone up so much over the past 7 months, and the answer is very clear. There's just right now there's just so much demand from the retail side, and it's just a matter of matching that demand with the responsibilities that the SEC is feeling the heat for, as Ben and Kimberly mentioned.
Yeah, absolutely. I mean, regulation is very interesting, and kind of going through the process of launching a crypto exchange, it's just fascinating to see how many steps needed and just how things constantly change. And first it was you need $10 million just sitting there, then you need to get a settlement agent, not this kind of settlement agent. Only this type of institution can be a settlement agent, which is like the equivalent of a clearing firm in the rates world. Then you can't launch, just a central limit order book. You have to have a central limit order book with RFQ, request for quotas, just different trading models. So I think the whole landscape is just in a state of flux, and it'll be very interesting to see where it ends up.
And we actually haven't touched on the fact that different states can regulate this also. New York State had the BIT license. They got out there early. It was one of the first ones, and it was one of the ones that everybody complained about. This was complicated because people from the technology side, we're learning about the implications of financial services. I was a muni bond underwriter for 30 years for government. I understand what it's like to be highly regulated, what the cryptocurrency folks did. And so marrying that, Tagomi came in and had a 7-month approval process. But their general counsel came from Goldman Sachs. He knew how to deal with the regulators.
Absolutely. I remember I had different states of different, I had a friend who was, constantly egging me on to buy Tezos on Coinbase and it wouldn't show up. And I realized that it's just, you can't buy Tezos when you're based in New York. And it's,
right.
It was fascinating to see.
Thank you guys. We have one kind of closing question for the panel, and then we want to open it up to Q&A. So for our audience members, put your questions in the chat so we can have a chat discussion and then also have the panelists respond to the questions. But a closing thought from Abhiram and me, what do you see as the most pressing challenges facing the cryptocurrency and blockchain technology space?
I would say that the biggest risk is kind of knee-jerk or short-sighted regulation, overreaction on the regulatory front, rather than trying to move at a more measured pace. I think, going to try to, they have to realize that, kind of the genie is out of the bottle at this point. This is a global phenomenon. And ultimately, there are many jurisdictions. They will have, differing approaches. You'll see potentially much more, hard bans and things like China. And ultimately, the innovators and the capital are going to flow to where they're treated best.
Yeah, I think I see a few different challenges. One is just the reputation. Like, people look at crypto, something you can do, illegal stuff with it. And I think their reputation sometimes goes over to blockchain, even though that's not the case. You kind of just, overcoming that reputational and image hurdle is one of them. Regulation, of course, as we've discussed. And then finally, just implementation, like, just working at a blockchain payments company. A few of the things I've seen are that one is, the technology is, you think the technology is the tricky part and the one that's hard to implement, but actually it's just integrating with the existing processes of banks that, takes up more than, 80% of the effort. And sometimes it's a multi-year closing process to sales process to close a bank. So I think just, integrating with legacy systems and managing that process is a challenge.
Yeah, so I think that the biggest challenge simply is China, and there's two parts of it. So, the way that China deals with cryptocurrency is quite interesting and different from the rest of the world. So China has strict capital controls, and there are many other countries in the world that have strict capital controls. And to get around capital controls, crypto used to be a way of doing this. Retail could buy Bitcoin onshore and then send the Bitcoin abroad. And then as a result, Chinese Bitcoin used to be at a permanent 10% premium. So you have to pay a 10% cost to kind of have this transaction go through. That no longer is easily available. All of the exchanges have moved offshore. They've moved offshore from mainland China. However, there still are many things that are related in cryptocurrencies that are related to the capital control systems in China. So many people don't know this, but Bitcoin mining is a way to kind of bypass capital controls as well from the Chinese perspective. And so, you're mining Bitcoin, you're paying electricity in local currency, and then you are generating Bitcoin, which can be sort of sold anywhere in the world. At least it's easier to do, and it doesn't have local currency restrictions from mainland China. And so I feel like this is a mechanism for bypassing capital controls, and this is a major concern for China. This is one of the biggest issues with capital controls, and over time we'll see what happens. This past week there have been quite a few announcements focusing on cryptocurrency mining in mainland China, and I think over time I'm very curious to see how this gets addressed, and it unfortunately really does affect the broader cryptocurrency landscape.
Yeah, I think everybody being reminded that this is a global market. As a matter of fact, when these big price changes happen, they often happen on Saturday night, late Saturday night. Is something that we cannot lose sight of. And I'm going to talk about something that is really blockchain technology more than crypto related. It's interoperability of blockchains. Getting that right, getting that to work will help scale the technological use of all these various stable coins and all the enterprise uses of blockchain. So developing that, as we're also looking at stabilizing these markets together, would be quite a force. I mean, it's almost like we're where the internet was in the 90s, where every large corporation had an intranet, but we didn't work together. We weren't sending emails to everybody outside of the corporation until afterwards, and until we figured out that we all had to have basically the same or versions of word processing, and spreadsheets had to talk to each other. Use exploded. That has to be transferred to this market, to blockchain technology.
Great, those were all excellent takes. Now we're going to turn to the audience for great questions, I'm sure. We already have a good one from Dan Schofler. And he asks a question, and it's kind of looped into a question Marina and I kind of drafted also, so this is great that we're all aligned here. Kind of thinking about, there are so many different cryptocurrencies, so many different coins. We talked about stable coins, we talked about Tether and things derived from that. Is there a specific currency that you all find to be the most interesting, or you think has the most promising future, or you think maybe is the biggest risk? What is a specific kind of coin out there besides Dogecoin? I know everyone's really interested in Dogecoin, but setting aside Dogecoin, is there some other kind of cryptocurrency that you think has properties that you think make it unique, or you think make it poised to be very successful in the future?
I think you guys probably know my answer by now. I'm a Bitcoin guy, have been since 2011. Really Bitcoin invented, was the first of its kind and essentially invented digital scarcity. And I don't think you can reinvent digital scarcity. All the coins since then have just decreased digital scarcity in a way. So I think, the reason I see promise in Bitcoin is because it is the one that has clearly achieved product market fit, and it is a complete product, which is basically to be an inflation-proof, non-sovereign store of value and settlement network. And I think, that alone, if that can be kept for the world, can bring us to a new era of prosperity, much as we saw under the classical gold standard in the golden era, the late 1800s.
Yeah, I'm also I guess more on the Bitcoin side than some of these other cryptocurrencies. But to answer your question, there's just so many cryptocurrencies. I think for those who are curious and looking into what else exists outside of Bitcoin, and there are things that are out there outside of Bitcoin which are super interesting. I would start with layer one. So layer one just means the base blockchain, and then a lot of these layer ones such as Ethereum and Polkadot have a ton of layer two projects, which are also cryptocurrencies, unfortunately. And so one layer one could have, in the case of Ethereum, 1,000 layer twos or other currencies that are built on top of Ethereum. So outside of Ethereum, which has 1,000 probably layer twos, I think Polkadot is the most interesting kind of Ethereum competitor at the moment. There's a few others out there such as Cardano and Solana. Polkadot is part of Web 3.0, and they have a pretty big slate of parachains that are coming out pretty soon with a parachain auction. So they're they kind of address some of this interchain operability issue that Kimberly was mentioning before. And then but but definitely do your own research, and it's not investment advice. It's a really fun exercise to perform.
Yeah, no, it's just crazy that like there are over 1,300 coins out there, and sometimes it's really hard to make sense of the whole landscape. And I'm still looking for models to kind of just understand the space completely. But Bitcoin's obviously the largest, the original one. Satoshi Nakamoto, whoever he is definitely a genius. Then the smart contract, aimed ones. Like Jeff was mentioning, Ethereum. The goal was to enable smart contracts. I think Polkadot and Cardano, proving to be rival networks. Then you have a lot of payment-based ones. We saw what happened to Ripple, but Ripple was one of them. I think Stellar Lumens is another. What else? People had problems with Bitcoin, transactions too. So I think Bitcoin Cash was a hard fork from Bitcoin, which is based on quicker transactions. I've also heard of Litecoin being like I don't really see it, but a potential competitor to Bitcoin. I think it's much faster. I remember I think Bitcoin's transactions take about 300 minutes to go through, while Litecoin was like around 2 minutes. So there's again a lot of activity, a lot of flurry. It's hard to predict what's going to happen, but I also see a lot of investors, a lot of big investors. Maybe even people like Shark Tank's Kevin O'Leary, who say we're only investing in Bitcoin and Ethereum, and they put 1 or 2% of their portfolio. This is a pattern I've seen again and again and again.
Yeah, I agree with everyone. Bitcoin is in a class of itself. The others, you're going to be looking at utility value of the coins, and I'm glad people finally brought up Ether and Ethereum, because that is where smart contracts are housed, where DeFi, and we're not even going to talk about all of that, is happening. But it's also where a lot of activity for enterprise use, trading of carbon tax credits, tracing supply chains for any variety of goods. That's where all that happens.
Another question, I've seen a few questions in the chat kind of around anonymity, security, from John Chambers, from Glenn Kashan. And I'm wondering, I feel like, to me, one of the most interesting spaces relating to cryptocurrencies and blockchain is developments in digital identity systems. So making sure we're balancing anonymity and decentralization with also having a good digital identity system that can help to make the whole infrastructure stack much more secure. Where do you see this balance playing out in terms of anonymity versus how we are able to have a good digital identity system that can scale the digital economy and scale digital payments?
I think we're mixing a lot of concepts there. I think blockchain can be extremely helpful in identity, and it's used for tracking identities, such that you don't, think about, we're talking about getting a mortgage, all the different places you have to go and prove who you are, proving your age, for doctors and nurses who want to go from place to place, proving that they're licensed. The companies checking whether people are actually graduates of the entity. There are myriad uses for blockchain for those purposes, and that's not cryptocurrency related. There are trade-offs. But people think of Bitcoin, and the point was made before. Bitcoin is not anonymous. You can track Bitcoin, and it goes back far. There are a lot of reports from Chainlink. They just identified the wallet where the last ransom was paid for the Colonial Pipeline. They saw the money go into the wallet, and they saw the money go out of the wallet.
Yeah, and I think similarly, so I'm going to guess this panel is mostly Bitcoin focused. So on the Ethereum side, if you look at NFTs, for example, right, which have been really hot over the last let's say 1 year, but even before that, there were CryptoKitties. NFTs are a great kind of mesh between retail and art and cryptocurrencies. These are non-fungible tokens. The Beeple piece sold for 69 million net recently. People want to have ownership of something, and there's so many fake artworks out there in the world. You can prove provenance through cryptocurrency, and I don't know if NFTs themselves are a bubble. There's some great artwork out there, but that's just one, I think, pretty good example of the desire for identity, right? Because I own this piece. At the moment, it's one thing that's strange about NFTs is at the moment, if I buy an NFT, anyone in the world can actually see it. And so I don't really know why I would buy one other than just telling the world that I bought one. If I buy something for 69 million, you can see it just as much as I can see it. So there isn't really any layer at the moment to distinguish that, but I think that's a great example.
But luxury goods makers, watches, persons, those kind of things, they're looking at using it.
To your point about anonymity, Marina, I think it's, it was one interesting trend I've seen when I was working at Truex, which was building an interest rate swaps exchange. The evolution of markets is very interesting. If you take the stock market, which is probably the most efficient and evolved market there is today, you first have some kind of barter system, then you start having some form of exchange like cash, then you start trading things on an exchange, like the New York Stock Exchange, people shouting across the floor. The next step in the evolution is things become digitized, so you can trade digitally. And then the final evolution is this a central limit order book model of trading, where if you're buying, say, Amazon stock from somebody else, right? You don't know who you're buying from. There's just a continuous price, that exists out there. Whereas if you go to, say, a Nike store and you buy a shoe, there's a fixed price. It's not. So I think the final evolution of markets is where the price is continuously fluctuating, like we see in the stock market or maybe in the crypto market, and you can trade securely but anonymously. So I certainly think that people have a preference for that. The market likes that.
Great. I mean, we've gone slightly over time. This was a really engaging discussion. And we really would like to thank all four of our panelists, Jeff, Kim, Ben, Shiv, and the Julius Rabinowitz Center, especially Pallavi Nuka and Nancy Turco, who are the real brains behind this operation. Marina and I are just nice faces that you see on the screen, but they played a very important role in putting this together. If you have any further questions that you'd like to ask our panelists, feel free to shoot them in the chat to the Julius Rabinowitz icon there. We'll be happy to pass that along and get you responses to that. Other than that, we wish you have a happy reunions wherever you are. And we look forward to doing this in a similar event again in person next year.